appearance of corporations, and the creation of railways were the catalyst that transformed bookkeeping into the practice of accounting. Of the two factors, railways was the most powerful. For goods and people to reach their destination, they needed distribution networks, shipping schedules, fare collection, competitive rates, and ways to evaluate if it is being done in the most efficient way possible. So the only possible way to focus on the efficient way is accounting. Shrinking of the country due to railroad put more focus on accounting, and people also started to invest. Investing was a game of knowledge or luck. People acquired stocks and companies with which they were familiar through industry knowledge or luck. Others blindly invested according to the encouragement of relatives and friends. There were no financials to check if you wanted to invest in a corporation or business, so the risk involved ensured that investing was only for wealthy. To attract investors, corporations began to publish their financials in the form of balance sheet, income, and cash flow statement. These documents were a proof of companies' profit-making abilities. To understand financial statements, we first need to understand the basic equation of accounting. What we have: cash, building, machinery, stock or inventory, minus what we owe, that is payables or bills or loans, is what we are worth. This is the fundamental of double entry bookkeeping, which is dated back to 1400s. To know more about the history of double entry bookkeeping, do check the link in the description box below. In other words, the worth or the equity is the value of enterprise belonging to the owners. So what we have is our assets and what we owe is our liabilities, and they should balance at any point in time. So an increase in assets will either reduce the asset or increase the liability, thus balancing the equation at any point of time. The balance sheet is thus the first financial statement which presents this accounting equation in a slightly rearranged form. That is, assets on one side will be equal to liabilities on equity on the other side. So balance sheet will show the financial position of any business at a given point of time. Let's take a small example to understand why the balance sheet should balance. Let's imagine Mr. X is starting a new company. He has invested $50,000 in the business, so he has $50,000 in cash on the asset side of the balance sheet. He has no liabilities yet, so he has a $50,000 in owner's equity. The balance sheet balances. Now the company buys a truck for $36,000 in cash. If nothing else changes, and if you've constructed a balance sheet right after the truck transaction, the asset side of the balance sheet would look like this. It still adds up to $50,000, and on the other side of the balance sheet, he still has $50,000 worth of owner's equity. The balance sheet still balances. Next, imagine that the owner decides he needs more cash. So he goes to the bank and borrows $10,000, raising his total cash to $24,000. Now the balance sheet looks like this. Now it adds up to $60,000. He has increased his assets, but of course he has increased his liabilities as well. So on the other side of the balance sheet, it will look like this. So that too adds up to $60,000. Note that owner's equity will remain unchanged throughout all these transactions. Owner's equity will be affected only when company takes in funds from the owners or pays out money to its owners or records a profit or a loss. To understand broadly about the balance sheet and the line items, let's take the extract from Facebook's annual report. Balance sheet of Facebook presents everything it has, that is assets and the right it owns, and everything it owes, that is the liability and what the enterprise is worth today, which is the shareholders' equity. At the first look of the balance sheet, we can understand that it is presented in the order of liquidity. That is, those assets which are liquid, easily convertible into cash, is listed on the top, while those assets which are not liquid, that is not converted into cash during the normal course of business, is listed on the bottom. So balance sheet is prepared in the descending order of liquidity depending upon the convertibility of the asset or liability into cash. Let's get into the details of various elements presented in the balance sheet. The first categorization is current assets. All the assets which can be converted into cash within 12 months are grouped under the heading current assets. They include cash and cash equivalents, which is the ultimate liquid asset like deposits with banks, marketable securities, which includes treasury bills or commercial papers, which can be easily converted into cash and which have a lower maturity period. Then it has accounts receivable from customers who have been given the goods but payment is due from them. It includes inventories. Usually service companies do not have much of inventories, but wholesalers or manufacturers will have finished goods or the raw materials to produce the finished goods as a part of their inventory, and prepaid assets where bills are paid before but services are not yet received. They are current assets not because this can be converted into cash, but because the enterprise or the business has already paid for the services in advance. The next categorization is non-current assets, which includes the fixed assets which are not intended for sale and can be used again and again. They include servers and computers. They also include other assets like patents and copyrights, which include the intangible assets which cannot be converted into cash in the normal course of business. The other side of the balance sheet is the liability or the obligations of the business. They are categorized and grouped as current liabilities which must be paid within 12 months from the date of balance sheet. They include accounts payable, the amount that company owes to its vendors. So the company will receive goods and services from vendors on day-to-day basis and they will not pay their bills immediately. So this liability to the vendor will be grouped and accounted as accounts payable. Accrued expenses. Expenses which have been accrued but not yet paid for. For example, salaries of the employees which have been earned by them but not yet paid for. Current portion of long-term debt. If a company owes $100,000 to the bank and $10,000 is due this year, then the $10,000 due to the bank this year will be categorized as a current liability. Taxes payable. Every time company sells something and makes profit on the sale, so a percentage of profit will be owed to the government as income taxes. This, when not paid, becomes income tax payable. The non-current liabilities includes shareholders' equity, which is the original amount of money the owners have contributed as an investment, and retained earnings, which is that part of the earnings which have been retained instead of providing dividends. So balance sheet is broadly classified as current assets, non-current assets, current liabilities and non-current liabilities and shareholders' equity. The balance sheet is prepared on a specific date. It can be a year-end or it can be a month-end depending upon the company's policies. So this information is relevant because it talks about the financial position as of that particular date. So balance sheet is always prepared on a particular date and it shows the financial position of the company on that reporting date. We have broadly understood the first financial statement, balance sheet, and what are all the various line items and how it is presented by the companies. Now, the next important financial statement is the income statement or the profit and loss account. The income statement gives an important perspective on the health of a business. It tries to measure if products and services that company provides is profitable. Let's take the extract of income statement from Facebook's annual report to understand further. The first line item in the income statement is the revenue or sales of the company. This is recorded in the income statement when company transfers a product or renders a service to the customer and the control of the product is transferred to the customer and company has the right to collect money from them. In the process of providing this revenue, company will incur a cost. For example, in a manufacturing business, the business will incur cost on purchasing raw materials to produce the finished good. So these are costs which are incurred to produce the sale or revenue. In other words, they are referred to as cost of goods sold or cost of services. So the net amount remaining after the cost covers the sales is the gross revenue or the gross margin. Company may also incur other operating costs such as sales and marketing expenses, research and development costs, and other general admin expenses. These expenses are operating expenses because they are incurred for the day-to-day functioning of the business. The income that is left over for the company after it incurs the operating expenses is referred to as the income from operations. Company may also incur expenses that are not related to the operations of the business. They can arise from non-operating activities such as interest on investment or any gain or loss on capital assets or income tax payable. So this non-operating income or expense should be added back or deducted from income from operations to arrive at the net income or profit for the company. After broadly understanding the balance sheet and the income statement, we can understand that the balance sheet and income statement are interlinked with each other. For example, when a sale is made on credit, the sales or the revenue on the income statement will increase and correspondingly the accounts receivable or the right to collect from the customer will also increase in the balance sheet. So this shows that any increase in the income statement will have an effect on the balance sheet. But when the customer pays for the accounts receivable or the right to collect no longer exists, but the cash on the other hand will increase, thus showing that there is a balance in the balance sheet. So this clearly shows the impact of double entry accounting to rightly assess the financial position of the company at any given point of time. The third most important financial statement that company produces is the cash flow statement. The cash flow statement will track the movement of cash through the business over a period of time. A company's cash flow statement is just like a cash register which will record all the company's transactions that use the cash and supply the cash or deposits. The cash flow statement shows the cash on hand at the start of the period plus cash received in the period less cash spent in the period, which will equal to the cash on hand at the end of the period. A positive cash flow for a period means the company has more cash at the end of the period than at the beginning. On the other hand, negative cash flow for a period means the company has less cash at the end of the period than at the beginning. If a company has a continuous negative cash flow, it runs the risk of running out of cash and not being able to pay its bills when due. So, a company has to focus when it has a continuous negative cash flow. To understand cash flow statement broadly, let's take the extract from Facebook's annual report. To understand cash flow statement in a more detailed manner, stay tuned to our channel and check the link in the description box below. The cash flow statement of the business is broadly divided into three categories, namely cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. The first category, cash flow from operating activities, talks about the cash flow from operations of the business. It is arrived by adding non-cash items to the net income from the income statement and also providing for the changes in working capital assets. The second category in cash flow statement is cash flow from investing activities. So this shows the cash that is being generated from the investment activities of the business. So they can include purchase of assets or investment in securities or a sale of securities or assets. The third category in the cash flow statement is cash flow from financing activities. It shows the cash that is used to fund the company. This can be borrowings from banks or issue of stock. So this also shows the capital structure of the company and how well it is being managed. So the sum of cash flows from operating, financing and investing activities is the closing cash balance which is reflected in the balance sheet. So we have broadly understood that there are three main financial statements that companies prepare, namely the balance sheet, the profit and loss account and the cash flow statement. We hope by seeing this video you will be able to understand broadly what the balance sheet and P&L and cash flow statement of any business comprises of. Stay tuned to Smart Roots for more updates and more information about the financial statements, the various accounting principles based on which it is being prepared.